last but not least, the final panel. And I'm very much honored. It's a great pleasure to chair this panel of very distinguished speakers from central banks in the Americas. They bring a vast body of experience in central banking and are, of course, uniquely qualified to talk about the topic of the last session, which is future challenges of monetary policy in the Americas. And of course, we've heard already about some of these challenges by Augustine at lunch. We've also heard before in the previous session that central banks in the Americas have built credibility and tackled the challenges during the pandemic. But of course, there are further challenges ahead. One of them is that, particularly in some countries, bringing inflation back to target still has to be fully achieved. The other issue that has been mentioned many times is that navigating the monetary fiscal policy mix is a challenge in a world of higher public debt and potentially higher risk premia for government debt. And of course, more generally, central banks will need to continue to guard and keep the financial system healthy. Also preparing for external shocks, like changes in global interest rates and trade tensions, continues to be a significant concern, as we've heard several times. And all of this is happening in an environment of more severe and frequent climate-related shocks and rapid technological change, as Governor Escriba also mentioned. So we're very much looking forward with this panel to further explore some of those challenges. Before I give the floor to the first governor, let me briefly introduce the panelists. I would like to start with the governor of the central bank of our host country, Victoria Rodríguez Ceja. She was appointed governor of the Bank of Mexico in January 2022, and before being appointed governor, she served as Undersecretary of Expenditures and of the Ministry of Finance and Public Credit from December 2018 to December 2021. Joining us virtually, and okay, there he is, we are grateful to have Tiff Macklem from the Bank of Canada. Tiff Macklem was appointed governor of the Bank of Canada in June 2020 for a 7-year term. He joined the Bank of Canada in 1984 and held various senior positions. And I still remember my first pass at the BIS was in the 90s, and we kind of interacted at that time, particularly on modeling, I remember. Tiff was appointed a deputy governor in 2004 and a senior deputy governor in 2010. And from 2014 until his appointment as governor, Mr. Macklem was dean of the Rotman School of Management at the University of Toronto. Our third distinguished panel is President Lorie Logan. Lorie Logan began serving as the 14th president and CEO of the Federal Reserve Bank of Dallas in August 2022. And previously, she had the important role of manager of the System Open Market Account for the FOMC at the Federal Reserve Bank of New York, where, of course, she played a very important role in the development and the implementation of the Federal Reserve's response to the COVID-19 pandemic, but also to the global financial crisis. And then finally, our fourth panelist is governor of the Banco de la República Colombia, Leonardo Villar. Leonardo Villar became governor of the Colombian Central Bank in January 2021. Previously, he was executive director at the International Monetary Fund for Spain, Mexico, Colombia, Venezuela, and 4 Central American countries. He was also a member of the board of directors of the Colombian Central Bank for 12 years and held various senior positions at the Colombian Ministry of Finance. So a wealth of not only central banking, but in general economic policy making experience. As Governor Macklem can only join us for a limited time, let me first give the floor to the Governor. Floor is yours.
Well, thank you. Thank you, Frank. I'm really missing being with you and my many central bank colleagues from the Americas. The thing about shocks is they disrupt more than the economy, but I am very pleased to at least be able to talk to you virtually about the challenges that lie ahead for central banks. There is lots to talk about. But my first order of business, I want to congratulate and thank Augustine Carstens for his leadership as general manager for the Bank for International Settlements. Your term, Augustine, has been marked by significant global upheaval, from pandemic shutdowns to war in Europe and double-digit inflation. These have not been easy years. Through it all, you've been a source of unwavering wisdom. Your clear thinking in the face of the unknown, your long view, and your deep understanding of our global interdependence, all combined with the experience and pragmatism of a former Minister of Finance and then central bank governor, have made you an invaluable leader. More than that, through the BIS, Augustine, you've brought us together with your friendship and your ability to get to the heart of the matter. You've helped us learn from each other, and you've made us better together. I know there will be an opportunity to celebrate you in Basel as your retirement in June approaches, but I really wanted to recognize your exceptional leadership in your home country. For those of us in the Americas, your special interest in our region has been deeply appreciated. Whatever you do next, I know Mexico and the Americas will be an important part. Thank you, my friend. Now let me turn. So now let me turn to the challenges ahead. We are facing a global economic landscape that has shifted in recent years, and this shift has important implications for central banks. As Augustine has highlighted in a series of insightful speeches, the structural tailwinds of peace, globalization, and demographics are turning into headwinds, and the world looks increasingly shock-prone. Higher long-term interest rates, elevated sovereign debt, slower economic growth, and lagging productivity all make our economies more vulnerable. Compounding these vulnerabilities are war, rising trade protectionism, and economic fragmentation. In addition, new technologies, including artificial intelligence, are set to disrupt existing industries and create new ones. And we're seeing more frequent catastrophic weather events as the impacts of climate change become more pervasive. As 2025 begins, we are facing new uncertainty with a shift in policy direction in the United States. President Donald Trump's threats of new tariffs are already affecting business and household confidence, particularly in Canada and Mexico. The longer this uncertainty persists, the more it will weigh on economic activity in our countries. If significant broad-based tariffs are indeed imposed, they will test the resilience of our economies in the short run and reduce long-run prosperity. Tariffs mean economies work less efficiently. There will be less investment and lower productivity. That means our countries will produce less and earn less. Monetary policy can't change that. What monetary policy can do is help with the short-run adjustment. But even here, monetary policy has to strike a balance. Significant broad-based tariffs will sharply reduce demand for our exports. At the same time, a weaker exchange rate, retaliatory tariffs, and supply chain disruptions will raise import prices, putting upward pressure on inflation. With a single instrument, our policy interest rate, central banks can't lean against weaker output and higher inflation at the same time. So we will need to carefully assess the downward pressure on inflation from weaker economic activity and weigh that against the upward pressures from higher input prices and supply chain disruptions. Other structural headwinds pose similar challenges for monetary policy. They'll impact both demand and supply. slowing growth while adding cost. Monetary policy cannot address these headwinds directly or offset their economic consequences. In a world with more structural change and more negative supply shocks, central banks will be faced with harder choices. And harder choices bring risks of public disappointment and frustration. We will face criticism about our decisions and about how well monetary policy is seen to have worked when confronted with forces that are mostly out of our hands. We'll be called ineffective or criticized for not doing enough, and some will challenge our independence. So what can all of us do? First, we can be humble about what we don't know, but also confident in the effectiveness of our frameworks. We didn't get everything right through the pandemic, and elevated inflation and higher interest rates have been difficult for our citizens. But in Canada, as in many other countries, inflation has come down, and we restored low inflation without causing a recession or major job losses. Guided by our frameworks, we can maintain confidence in price stability. Second, we need to be just as clear about what monetary policy cannot do. There will always be forces beyond our influence, and while we will need to understand those forces, we should be clear that understanding is not the same as controlling. And we need to avoid the temptation to overload monetary policy by expecting more of it than it can deliver. Third, we can recognize that the world has changed. Structural headwinds and supply shocks require different types of information and analysis. This means investing in richer information about the supply side of the economy and building models that can analyze sectoral shocks and their transmission. It means reaching out and listening to households and businesses. It means looking at our economies through different lenses, regularly challenging our assumptions, and using scenarios to help manage uncertainty. Fourth, let's acknowledge that working together has never been easy, and it is getting harder. But let's also remember it's important. We are more effective if we confront our shared challenges together. The shared resolve of central banks to fight the post-pandemic surge in inflation helped us all bring inflation down. This was a positive international spillover, and together we can generate other positive international spillovers. Finally, we need to remain evidence-based, technocratic and professional, and free of political influence. We need to be open, accountable, and transparent. And we need to be learning institutions. When faced with valid criticism, we should critically evaluate our policy actions and be willing to improve. Being independent and accountable and continuously learning is how we build trust. The world is a tougher place today than it was just a few short years ago. And facing the headwinds will not be easy. But that's why we have independent central banks. We're designed for tough times. I look forward to hearing from my esteemed colleagues on this panel. Thank you very much.
Thank you very much, Governor Macklem, for reminding us what central banks can and cannot do. And with that, I turn to Governor Rodríguez for her introductory remarks.
Thank you. Bueno, no sé si funciona el micrófono bien. Good afternoon. Muy buenas tardes a todas y todos. First of all, I would like to thank the BIS and its representative office for the Americas for the invitation to participate in this panel, and to congratulate Agustín for this enriching initiative. Muchas gracias, Agustín, por reunirnos el día de hoy. Let me start by saying that Banco de México's monetary policy conduct has focused at all times on the accomplishment of our priority mandate of price stability. When global shocks derived from the pandemic and the war in Ukraine led to a clear and pronounced upward inflationary trend, a clearly restrictive monetary policy stance was attained as required by the severity of the episode. The hiking cycle was concluded when the disinflation process started and made progress due to the fading of the effects of global shocks and the actions of the monetary policy implemented. Later, as disinflation advanced, the inflationary outlook called to start reducing the monetary tightening, and we decided to initiate this process gradually. Throughout last year, although headline inflation was affected by non-core component volatility, it located at 4.21% in December. This reading was the lowest for a year-end since 2020. Later, it declined to 3.69% in the first fortnight of January 2025. On the other hand, core inflation kept declining during 2024. Its evolution confirmed the noticeable improvement to resolve the inflationary episode originated by global shocks. Core inflation has located around its pre-pandemic historical average for the 2003 to 2019 period, according to the most recent data. The permanent inflation target was defined at the start of that period. In the first fortnight of January 2025, core inflation stood at 3.72%. Regarding its components, merchandise inflation has reached particularly low levels, clearly below those previous to the pandemic. Moreover, services inflation, although it remains at relatively high levels, it has already shown gradual reductions. This suggests that this inflation would be, to a greater extent, generalizing further. Going forward, headline inflation is expected to converge to the 3% target in the third quarter of 2026, and core inflation to reach that level in the second quarter of that year. These forecasts are subject to risks. The persistence of core inflation 3% target. We consider that this is consistent with a lower level of the reference rate relative to that demanded due to global shocks, although the monetary stance still should remain restrictive. The board estimates that looking forward, it could continue calibrating the monetary policy stance and consider adjusting it in similar magnitudes. It anticipates that the inflationary environment will allow to continue the rate-cutting cycle, albeit maintaining a restrictive stance. We contemplate that in the next meeting, we may consider a downward adjustment of similar magnitude. We are anticipating that the inflationary environment will allow for further cuts during the rest of the year, although maintaining a restrictive stance. Without losing sight of the fading of global shocks, the progress in disinflation, and the levels already reached by headline and core inflation, we will remain vigilant to current challenges in upcoming meetings. In that regard, we are facing the uncertainty related to the potential effects of policies that the new American administration may adopt. Given our high economic integration with the US, if policies affecting trade and financial flows between the two countries materialize, it would have consequences for the macroeconomic conditions of our country. The effect on Mexico's economic activity would be negative, while those on inflation would have counteracting outcomes. Although greater economic weakness would tend to moderate price pressures, a greater exchange rate depreciation could generate upward pressures on inflation. In this sense, inflationary pressures could be observed both to the downside and to the upside. The challenges that the Mexican economy will face in 2025 highlight the importance of having solid macroeconomic fundamentals, as they allow facing such events from a position of resilience. Mexico stands out among emerging economies for the strength of its macroeconomic framework. In this regard, several macroeconomic pillars of the country stand out. First, external accounts are sustainable. An adequate level of international reserves that may be complemented with resources from the flexible credit line contracted with the IMF. The banking system maintains a solid position in terms of liquidity and capitalization. A significant fiscal consolidation was approved for 2025 with the aim of maintaining the soundness of public finances. And the country has a flexible exchange rate regime which operates as a shock absorber. The latter has allowed us to focus fully and with a long-term perspective on achieving and preserving an environment of low and stable inflation. Thank you.
Thank you very much, Governor Rodríguez. And then we turn to President Lorie. Logan, please.
Thank you. Thank you, Frank, for the earlier introduction and also for moderating today's discussion. And I want to thank the BIS for inviting me to participate in this distinguished panel and for hosting this event at such an important time. International dialogues like today generate so many valuable insights about how central banks can navigate the current environment, and I'm really pleased to be able to be here this afternoon. And I too want to thank Augustine for his leadership and his friendship over so many years. The theme of today's panel is future challenges for monetary policy in the Americas, and I have to say when I thought about today's panel, it was tough to think about where to begin. I think one challenge, of course, is to note all the important challenges when we've been each asked to keep our remarks to less than 5 minutes. But today I would like to highlight 3 topics in particular. The reconfiguration of global trade patterns and supply chains, the shift to a higher interest rate environment, and the need to keep inflation expectations well anchored after the surge in inflation following the pandemic. But before I discuss these 3 topics, let me note that the views are mine and not necessarily those of my colleagues on the FOMC. In recent years, companies worldwide began to reorganize their supply chains in response to disruptions experienced during the pandemic, as well as geopolitical developments. Government policy changes in this space are ongoing, and the resulting changes in trade patterns could leave a substantial imprint on economic activity. For example, a Dallas Fed economist and a colleague at the Banco de Mexico found in their joint research that tariffs on China drove growth at Mexican firms integrated into global supply networks. Central bankers will need to parse what these shifts mean for the inflation and employment outlooks and for capital flows. At the Dallas Fed, we recently launched our Global Institute to study these and other questions, and we look forward to generating new insights that can advance the missions of the Federal Reserve and our other central bank colleagues. Turning to my second point, following the global financial crisis, many experts thought a core challenge of modern central banking was downside risk to inflation, resulting from the proximity of interest rates to the effective lower bound. While a return to the lower bound remains one scenario to prepare for, the past few years show we must be equally well prepared to achieve our goals when rates are well above zero and inflation risks are to the upside. Related, this brings me to my third point. Central banks will need to ensure inflation expectations remain well anchored following the recent global inflation surge. High inflation has been costly for households and businesses. It would be surprising if this episode didn't cause people to reevaluate how they expect inflation to behave going forward. In the US, while market and survey-based estimates of long-term inflation expectations have remained largely stable, survey measures of inflation uncertainty rose sharply at the start of the pandemic, and they remain elevated. I take this as a reminder that expectations won't stay anchored forever on their own. In the end, monetary policymakers have to achieve what the public expects. And as we all know, well-anchored inflation expectations are critical to success in monetary policy. History teaches that when inflation expectations become unanchored, central banks often can restore price stability only at a great economic cost. This lesson figures centrally in my thinking about monetary policy for the US in the near term. I think the possible policy strategies for the FOMC in 2025 boil down to two key alternatives. In some scenarios, it will soon be appropriate to resume reducing the Fed funds target range. In other scenarios, we'll need to hold rates, at least at the current level, for quite some time. Inflation made progress toward the FOMC's 2% target in 2024, while the labor market remains strong and stable. If these trends continue, the US economy will have achieved a soft landing. Yet we've been here before on inflation. It cooled substantially in late 2023, then resurged in early 2024. And January 2023 was unusually strong as well. My team's analysis and conversations with business contacts suggest these bumps may result from an interaction between annual pricing decisions and the business cycle. Many businesses set prices once a year in January, and they have more pricing power when the economy is strong, as it has been in recent years. We don't yet know whether 2025 has brought another such bump, but if inflation rises, it will be a signal that monetary policy has more work to do, both to restore price stability and to keep demand in balance with supply so we can sustain price stability. Now, what if inflation comes in close to 2% in coming months? Well, that would be good news. It wouldn't necessarily allow the FOMC to cut rates soon, in my view. Suppose, for example, that as the first quarter unfolds, monthly inflation figures come in at a 2% annualized rate. Labor market indicators hold right where they were all fall. And consumer spending and business investment also stay strong. I'd find it hard to say monetary policy was meaningfully restrictive in that scenario. One aspect of the global higher rate environment is that the neutral interest rate appears to have moved up, though it's uncertain exactly how much. On-target inflation, alongside 2 quarters of stability in the labor market and demand, would strongly suggest that we're already pretty close to the neutral rate, without much near-term room for further cuts. On the other hand, if the labor market or demand cools further, that could be evidence it's time to ease. There are many uncertainties right now beyond the near-term inflation and employment data. I mentioned trade policy. And as we'll probably come back to later in the panel, financial conditions have also been volatile. But to me, the monetary policy implications of these uncertainties generally come down to whether sustainably restoring price stability requires keeping rates at least at the current level or moving lower. And in choosing a path, we should be guided by the need to maintain well-anchored inflation expectations, which are fundamental in the long run to achieving both sides of the FOMC's dual mandate for monetary policy. So thank you for continuing the conversation.
Thank you very much, President Logan, for going through some of those scenarios and what it may mean for monetary policy going forward. And let me then turn to Governor Villar.
Well, thank you, Frank. It's very difficult to speak the last after these interventions of my colleagues, which I entirely share. So it's very difficult to say anything new. And even more when we had a launch in which Agustin Carstens mentioned the challenges that we may have in the future with monetary policy, which I subscribe entirely. And I took note of those challenges. It's my presentation, essentially, which is uncertainty, to deal with uncertainty about tariffs, about geopolitics, to deal with the high public debt in most of our countries and at the world level, to deal with the international divergences in policies, and to deal with the sluggish productivity growth, which may push us to ease monetary policy when we should not do that. But as Agustin said, we should deal with all these challenges, taking in mind that the instruments we have as central banks are instruments that allow us to concentrate on inflation and in keeping inflation down, and in keeping inflation under control. So I entirely share those views, and it's very difficult to say anything else. But I will try to, to say that. In the case of Colombia, there are still significant challenges to bring and consolidate inflation around the target. In a context of very uncertain fiscal policy, global trade fragmentation, and growing concerns about global financial conditions. Inflation has experienced a significant drop in the last 2 years. Headline inflation has fallen by more than 8 percentage points since its peak in April 2023, when it reached 13.3% to 5.2% last December. Still, inflation in Colombia has proven to be more persistent compared to other countries in the region and remain above the central bank's 3% target. This persistence is mainly explained by a strong indexation to past inflation, which has to do with the lack of credibility in a country in which inflation was too high for many years in the past, to exchange rate pressures, especially during the last quarter, and to significant increases in the minimum wage. With regards to the minimum wage, they have been, the minimum wages have been increased every year well above the observed past inflation during the last 4 years. For 2025, again, the government announced an increase of 11%, which represents almost 6 percentage points above the last year's headline inflation and 8 percentage points above the inflation target. So it can produce additional inflationary pressures, mainly in the services sector, which has inflation stubbornly high, as happens in many other countries of the world. In our case, around 7%. Inflationary pressures have also risen since the last quarter of 2024 as a result of exchange rate volatility associated with global developments and with domestic larger than expected fiscal imbalances. Government revenues fell more than expenditures in 2024, and the central government deficit, which was projected to close around 5.6% of GDP, may end up at 6.8% of GDP, well above the limits imposed by the fiscal rule. In addition to this, the 2025 budget was rejected by Congress due to overly optimistic revenue projections, and therefore, both the budget and fiscal results remain surrounded by a high level of uncertainty for this year. The same is happening with the government sectoral policies, particularly those related to health, energy, education, and infrastructure, in which the current government has shown a significant anti-private sector bias. Global geopolitical fragmentation and uncertainty around trade policies of the new US administration may also create difficulties in the process of adjustment of inflation in Colombia. The US is Colombia's largest trading partner, and that implies that potential trade restrictions, along with economic and financial sanctions, such as those with which the US government threatened Colombia last week in the context of the debate about deportations, will have significant impacts on our economy. Furthermore, the US immigration policies could create major challenges for Colombia through the effects on remittances and their impact on the disposable income and consumption of Colombian households. Around 50% of remittances come from the US, so the impact of stricter immigration policies or any changes in the tax policy related to remittances will have also significant impact on Colombia. In this very uncertain context, inflation expectations have also gone up during the last few months, standing today at around 4% for end 2025, which is the upper limit of the tolerance range of plus or minus 1 percentage point around the 3% target. Hence, our main challenge as central bank continues to be bringing inflation around the target and consolidating credibility in our inflation targeting framework. That's why Banco de la República keeps a very contractionary monetary policy, and the process of reduction in the interest rate that we had been pursuing for 9 consecutive board meetings since December 2023 was paused in our January meeting last week. Even if we have the future full control of inflation, a question that I think we have to think about is whether we should think on a goal of around the price level. what we have seen in the States, but it's a discussion that is all around the world, is that the population understands that inflation has gone down, but keeps insisting that the prices are not what they used to be. And I think that's something that is a challenge of communication, perhaps, but maybe also a challenge for policy that, of course, is not a short-run challenge that we can address today with keeping the goal of counter-cyclical policies on economic activity. Having mentioned the huge challenges with regards to the traditional macroeconomic role of monetary policy, I would like to mention shortly other important challenges we face as a central bank in relation to more operational tasks that have been discussed earlier today. In particular, the development of an interoperable fast payment system, the possibility of issuing a CBDC, the improvement of our cross-border payment instruments, and the regulation of crypto assets. In Colombia, our primary effort currently focuses on the implementation of a fast payment ecosystem developed by the central bank, which will be launched in the third quarter of 2025. It will be a fully interoperable system that is expected to bring more competition to the market, building on the foundations of well-established private fast payment systems that we already have in Colombia, which, however, work as closed gardens for few groups of large institutions. We expect that the launching of the new platform that we call Breve will lead to a significant progress in digital payments. In that context, there is an ongoing debate regarding the necessity of launching or not a retail CBDC. Our official stance on this debate is that a retail CBDC could bring an additional set of significant operational and reputational risks to the central bank, while its potential benefits, such as programmability or offline payments, could be enabled by using fast payment systems with commercial bank money. On the other side, we find more positive arguments regarding the potential benefits of using the crypto technology to tokenize commercial bank deposits at the central bank, thus creating a wholesale CBDC. These types of arrangements, the wholesale CBDC, may simplify settlements among commercial banks to facilitate cross-border transactions, including remittances, and make them faster and cheaper. Wholesale CBDC may be useful to obtain interoperability among wholesale payment systems in different currencies, and could also be useful in processes like the integration of the stock exchanges of Colombia, Peru, and Chile that is currently underway. This type of CBDC is consistent with the Agora project mentioned by Hyun this morning. The tokenization of central bank deposits in a wholesale CBDC is a good example of potential use of crypto technologies to improve the payment system in our countries. I must confess, however, that I find extremely risky the way in which crypto assets issued by the private sector are growing very rapidly without the required regulation, especially when those crypto assets are designed to work as means of payments or to serve as stable coins that mimic the performance of national currencies issued by central banks. The regulation of such cryptocurrencies is clearly one of the most difficult challenges that central banks and supervisory and regulatory agencies may have during the next few years, both in advanced economies and in emerging market economies. The regulatory framework should allow mitigating risks, but without affecting incentives for technological innovation. In this regard, in Banco de la República, we have agreed that the new regulation should pursue the following objectives in line with what Hyun and Professor Christine Parlor said in their presentations today. First, to guarantee that the development of digital assets does not risk financial and macroeconomic stability or reduces the capacity of central banks to control monetary and exchange rate policies. Second, establish the rules that help protect consumers and investors of digital assets. Third, prevent the use of these assets in illicit activities. And fourth, establish a regulatory framework based on the principle that the same activity implies the same risks and therefore the same regulation. Meeting these objectives will be key to gaining transparency and clear functioning of digital assets while allowing to take advantage of their innovation and new activities that can have a positive impact on economic growth. I stop here. Thank you.
Thank you very much, Governor Villar, and also for widening again the scope of all the challenges that central banks are facing, particularly in the technology field and in the field of payments. Maybe we can continue the conversation by addressing and deepening some of the questions that were already discussed. Governor Macklem sort of emphasized the challenges that will come from the fact that we are likely to continue to live in a world where supply shocks will continue to be important. And of course, there is this sort of common wisdom that to some extent, when these supply shocks are temporary, that one can look through them. But of course, what we've seen in the past is that, and you've mentioned it in your introductory remarks, that some prices, and particularly services inflation, has been relatively sort of sticky. Yeah. And so one question is, how do you interpret that stickiness? Is that something that we will have to take into account also for future shocks? And of course, related to that also, what are the risks of some of the trade tensions that is one example of these type of supply shocks?
Yes, thank
Governor
you very
Rodríguez.
much for your question. Well, I will start talking about the first question you asked. What risk do trade tensions pose for inflation in the coming years or in the future? And you mentioned what I said about services inflation in Mexico, that as in all or other countries have been sticky. And I would like to start by saying that although this inflation process has its own peculiarities, it is different from the other, but I think we can say that we have observed that they go through some similar phases. First, at the beginning, when the fading of the shocks that originated the episode that originated the inflationary episodes diminished, the inflation leads or has a faster decline. And later, we observe that inflation, when it gets closer to the target, the pace at which inflation comes down usually diminishes. So I would like to start by saying sharing these initial ideas, and going into the case of Mexico, I would like to share that during this episode, with the mitigation of the shocks and of course the implementation of the monetary policy stance, the strong response that Banco de Mexico started to get the inflation to the target, we started to see the disinflation phase process started, I would say, in early 2023, and headline and core inflation diminished quite fast from particularly high levels. You might recall that the headline inflation had a peak in August 2022 at 8.7%, and it diminished to 0.66% in December 2023. Core inflation had a similar behavior from 8.51% in November 2022 to 5.09% at the end of 2023. So we observed that at the beginning of the fading of the shocks, as I've mentioned, we saw a decline of the inflation in a relatively quiet pace. Then, during 2024, core inflation continued decreasing primarily due to the behavior of merchandise inflation, as I've mentioned. However, headline inflation was affected by the volatility of the non-core component. And in 2024 and in 2023, services inflation showed persistence. This contrasts with the clear downward trajectory of merchandise inflation. Both components undoubtedly were affected by cost pressures. However, as we all know, good inflation faced a more dynamic demand since the beginning of the pandemic. As we all know, there was a reallocation of consumption from services to merchandise because of the confinement. And I think that allowed companies to pass through higher costs to consumer prices more quickly. But we did not see the same behavior on services. Services sector faced a weak demand for the same reasons I've mentioned, which made the pass-through more difficult. And as demand recovered, accumulated costs were passed through consumer prices. However, the process has been slower than anticipated. And going to your next question about the risks of trade tensions, I think it's useful to go back and review how the period of increased trade cooperation was a powerful disinflationary force. First, as we all know, consumers gained access to a greater variety of cheaper goods, and a greater competition from foreign producers disciplined the price formation process. Also, firms gained access to higher quality inputs at competitive prices. We saw also technology adoption and innovation and a robust productivity growth that led to higher economic and wage growth without inflationary pressures. Of course, Mexico benefited from this process. NAFTA in particular represented not only lower tariffs, I think, but the creation of an institutional framework that increased North America's competitiveness through sophisticated regional production chains. However, I would like to highlight that we have been experiencing for over a decade a reaction, I would say, against globalization, with the risk of oversimplifying. I think we can identify insufficient redistribution of the gains from trade to those affected by it. Of course, there are other factors that contribute to a less globally integrated economy, such as national security concerns, among others. And I would say that in the case that tariffs become more persistent and generalized, or that production relocates in response to factors different than cost efficiency, the world could face decreased competition, lower investment levels, and less incentives for technological adoption and innovation. And I think that could translate into lower global productivity. And I think central banks, of course, have to remain vigilant to the evolution of the trade tensions. Our job, as always, is to adopt actions to ensure orderly price adjustments and to anchor long-term inflation expectations. And I would like to close by saying that as policymakers, we need to reflect on how we got here, how we are where we are today. And I think that it is important and would allow us to address the task of ensuring a more equitable growth and to strengthen the international cooperation efforts needed to face our shared challenges. Thank you.
Thank you very much, Governor Rodríguez. Many of these structural forces that we talk about, and of course, fragmentation or deglobalization is one of them, but also digitalization, climate change, population aging. They're not only a source of sort of supply shocks or shocks in general, but they also affect some of the so-called star variables that are important in sort of setting monetary policy. So, President Logan, I mean, how important do you see concepts such as the neutral interest rate for monetary policy making? I mean, which factors do you think affect the natural interest rate? And I don't know if you also have a perspective on sort of the international dimension, where, of course, international capital markets come in. What are sort of some of the drivers? Are they the same across the world, or do you see also differences?
Well, thank you for the question. And I did bring up the neutral rate in my opening comments. But when I think about monetary policy, I often don't start from the neutral rate. I think because I come from a background in financial markets, and I think the nuances of financial markets matter so much. I start thinking more about financial conditions more broadly. Households and businesses don't usually borrow, save, or invest in an overnight risk-free rate like the Fed funds rate. Instead, as we all know well, most borrowing, saving, investing takes place at longer tenors and often incorporates various risk premia as well. So when I think about whether monetary policy is in the right place to accomplish our dual mandate goals, I tend to think about whether broader financial conditions are appropriately restrictive or accommodative, or whether broad financial conditions need to move from where they are today. Yet, we don't control financial conditions. We control the overnight policy rate. And that overnight rate's relationship to broader financial markets can vary over time. So I don't usually try to judge whether the policy rate itself is restrictive or accommodative, but instead I think through how moving the policy rate will affect those broader financial conditions. All that said, I think it's helpful to have some benchmark for the policy rate over time. And here I think estimates of the neutral rate, or R-star, are one important benchmark. But as I know we've all talked about, I would highlight the word estimates in that comment. The neutral rate can't be directly measured. It has to be estimated by consulting models and observing the evolution of the economy over time. And the estimates depend on so many assumptions. It's also necessary to think about the time horizon, and the neutral rate in the long run can differ from its value today. As a result, when we see estimates of R-star in the US right now, they vary pretty widely. I was looking across a suite of available models, and the estimates of the neutral real interest rate for the US range from 0.75% to 2.5%. So a pretty wide range of those estimates. And if you look in the December summary of economic projections, FOMC participants' estimates of the long-run real Fed funds rate ranged from 0.4 to 1.9%. But one thing these estimates generally have in common is that most of them have moved up substantially since before the pandemic. And for example, in the December 2019 SEP, estimates of the long-run real Fed funds rate ranged from 0 to 1.3%. So you can see the shift that's happened over the last several years. You asked sort of how I think about the drivers of those. Conceptually, the neutral rate depends on the balance between the supply of investment and the demand for investment. Factors that move investment supply or demand also move the neutral rate. And I've been categorizing those into four main buckets. Business investment needs, which can result from drivers as varied as productivity growth, new technologies that we've talked about, or change in trade patterns that we focused on today. Demographics, because longer life expectancies and lower population growth raise those desired savings. And risk premia, because higher structural demand for safe assets means investment supply and demand are in balance at a lower risk-free rate, all else equal. And of course, there's global fiscal policy, which reflects the desired savings and investments of governments. Demographics, one of those four, change slowly and have weighed on neutral rates for many years, but the other factors can move quickly. And post-pandemic, many of them point in the direction of higher investment, lower savings, and thus higher neutral rates, just as the models and the estimates I talked about have shifted. Because global capital markets are relatively open, I tend to think these factors operate globally and affect neutral rates across economies. Indeed, when we look at the model estimates of R-star, they've tended to move in parallel across developed markets for the past half century. But country-specific developments also matter. So I think it's important to think about what we're seeing in each of our jurisdictions. But all this just brings me back to where I started, with the importance of broad financial conditions. While some of the drivers of the neutral rate are purely economic, others, such as risk premium and capital flows, relate to those nuances that we see in financial markets. And adjusting neutral rate estimates to account for these financial factors is an inexact science. And so while measures of R-star are a helpful benchmark and an important one to look at, it'll always be important to take broad financial conditions into account in thinking about setting the monetary policy rate.
Thank you very much. So one of the things we haven't actually talked a lot about at this inaugural Chapultepec conference is climate change. And so let me ask a question to Governor Villar about how do you see the impact of physical risks, and unfortunately we've seen quite a number of those events over the past months, but also the transition risks for monetary policy.
Okay, thank you for the question. It is very difficult to assess the way and the magnitude in which physical climate shocks and the energy transition may affect monetary policy. My short answer will be that they create additional volatility in inflation and in GDP figures that may require more active policy management in order to stabilize those variables. In addition, for a country like Colombia, which has been a net oil and coal exporter, energy transition may imply a long-term decline in export revenues, lower potential GDP growth, higher current account deficits, and higher neutral real interest rate. The magnitude of these permanent impacts is, however, extremely difficult to estimate. Our staff at the central bank has made research on this and suggests that the research that suggests that the impact of global warming by 2100 could reduce GDP by nearly 8% without mitigation policies. This highlights the importance of proactive climate policies, including efforts to mitigate the effects of climate change. However, most of those climate policies are a responsibility of the government and not of the central bank, which do not have the instruments for that. Still, the Banco de la República is already incorporating climate-related variables, such as El Niño shocks, into its forecasting models. This provides a better understanding of how extreme weather events can influence inflation expectations and prices. Given the potential for persistent and frequent climate shocks, central banks may need to adopt more flexible and responsive monetary policies to anchor inflation expectations and avoid second-round effects. From the exercises that have been done with those models, it seems clear that, in general, monetary policy cannot use a look-through approach when it faces an increase in inflation as a consequence of climate shocks. The main reason is that many prices and also wages in Colombia show a strong indexation to observed inflation, which implies that any increase in inflation may create long-term upside pressures on inflation, even if the initial shock was strictly temporary. It is very difficult to avoid second-round effects from an inflationary shock in a country like Colombia with the strong inflation indexation mechanisms. It is very likely that the optimal response to an increase in inflation, even if it is caused by a temporary shock, will be through a monetary policy tightening. I would say that.
Thank you very much. I think we're getting close to the end, but maybe I can just ask one final question. Governor Macklem talked also a lot about communication. I mean, given these many challenges that we're facing and the very uncertain environment, how do you think about sort of central bank communication in this environment? I mean, some of you emphasized the importance of having anchored inflation expectations. What are sort of the tools that we have in order to make sure, indeed, that in this volatile world, inflation expectations remain anchored and price stability is maintained? I mean, I don't know who wants to take that question. Governor Villar?
I would say something that is just to emphasize the importance of having a specific goal for monetary policy. I think if we start having many goals, it will be very difficult to communicate. If we relate monetary policy with inflation, we can communicate to the public that we are the responsible institution for bringing inflation down. I have seen the debates in my own country in which the government says, no, we brought inflation down, so now you have to bring down interest rates. So I think it's very important to communicate which is the causality from interest rates and monetary policy to inflation, and keeping it simple is very, very important for the purpose of anchoring inflation expectations and getting some support for our role.
I think the clarity of our goals and being and staying focused on that, I completely agree with that comment. I think that's been a real benefit of many of the frameworks that have been put in place and communicated publicly, that clarity of goal. I mean, I like the opening comments also about humility, particularly in the uncertain world and environment that we're in. And I think expressing that humility is really important. Because of that, I think it's also important that when we're communicating about our economic outlooks, we often talk about our modal outcomes and our modal forecasts. But in this world of uncertainty, I think it's really important to talk about the scenarios and the reaction function. And so in my remarks today, I really tried to think about how the data that we may see may influence the way I think about policy. I think that's really important in a world with so much uncertainty.
Thank you. Governor Rodríguez, you want to have the final word?
Thank you. Well, I would, of course, agree with my colleagues. Communication is of the utmost importance, and I think during this difficult episode that we have faced globally together, communication has been really important, and I think clear and consistent communication along with a firm commitment and the communication of that commitment, of course, to price stability is essential in anchoring inflation expectations And I think what we have seen, speaking about what we have seen in Mexico, is that the inflation expectations, long-term inflation expectations, have been well anchored. And we at the board at Banco de Mexico are really committed and continue to look to improve our communication tools. Banco de Mexico has gone through different tools along the way through many years, and many of the people that are here come from Banco de Mexico, if they are today, or most of you come from Banco de Mexico, even if you are in another places. And I'm glad to meet all of you here. And I would like to close by saying that the communication is totally really important. We have, as you know, started a new communication during the pandemic episode, as we thought it required. And I think that was very helpful to, first of all, communicate the commitment of the board, as Banco de Mexico has always been. And, well, finally, we are seeing that this inflationary process is going forward, and we will continue to remain committed, of course, to the price stability mandate. Thank you.
Well, thank you very much. It was great to hear your views about the future challenges for monetary policy in the Americas. I think I can only thank you very much for participating in this conference, and let us give a round of applause to